Hi, I'm Chad Padovitz. Welcome to the Talaria 2021 Reset webinar. After a tumultuous year of 2020, I think we're all looking forward to what 2021 may have in store. And I'd like to take you through what we think some of the things that should be addressed and we're looking at. And those are around the concentration within equity markets, some of the monetary and fiscal stimulus that has been driving it, as well as income and equity areas where one should look at for future returns. We're going to start by looking at some of the equity concentration risks inherent in markets currently. Now, this has been a fact for some time, but it has only increased, such that the top 10 companies in the S&P is over 28% of the index. Now, this significant concentration is most concerning when one thinks about the valuation of these companies and the rapid appreciation they've had. So you are buying in the index very expensive companies that have run up significantly already. As an example, Tesla joined the index late last year, and that is approximately 1.8% of the index, but having appreciated over 800%. Now, investors who were in the index never got any of that benefit because it joined quite late. So that's an example of some of the risk you're taking now, because that's a company that has around 300 times earnings that you're paying up front. The rest of the top 10 has an average of about 30. So this gives you some idea of how optimistic one has to be on those companies to expect further gains from this level, as well as the risks that you take by buying them. So let's look a bit more of that in detail. One is the value of fiscal stimulus, primarily driven to help economies cope with the COVID pandemic, has been unprecedented. Double-digit amounts have been across almost all advanced economies. And this is in combination to record low, in many cases, negative interest rates and high levels of quantitative easing. However, over time, this is likely going to be inflationary. And we can already see that when one looks at the market's expectations of future inflation, which is better defined as the 5-year forward inflation expectations, that has already gone over 2%. And as you can see in the graph attached, that has certainly been appreciating in the last recent period. Now, why this is important, as we'll talk about, is the higher inflation expectations does have an impact over time with valuations of equities. And this is one of the key risks we see, as well as opportunities in equity markets. Lower inflation drives valuations upwards because it produces a lower discount rate and vice versa. So these policies which are driving up or potentially driving up future inflation are a real risk to certain segments of the equity markets. Now let's look at an example of what lower inflation and interest rate expectations have against equity valuations. If one looks at the graph attached, you can see the NASDAQ valuation has gone from approximately 30 times to 60 times over the last couple of years, while the cost of 30-year money has effectively halved. So the halving of one is leading to the doubling of the other. Now these things don't necessarily have to be perfectly proportional, but certainly there is a significant link between lower cost of capital, lower inflation, lower discount rates, and higher valuation. And we are seeing that in the extreme in the high growth segments of the equity market. And this is where we believe a key risk exists from future inflation. Despite the exceptional strength we've seen in certain of these growth equities and the high valuations that they have achieved, there were certainly signs towards the end of last year of a rotation towards broader segments of the market and those that are more economically sensitive. And this has been driven by an improving economic outcome, driven by the effectively start of a new economic cycle. So the pandemic brought one to the end, and there's a new economic cycle beginning now. And you can see that in the ISM orders, in Purchasing Managers Index orders. So there has definitely been an increasing economic activity, which is helping more economically sensitive companies and sectors like financials, industrials, energy. And those have benefited most recently. There were certainly a few months in late 2020 where rotation was in effect. And you can see that in the value index doing significantly better than the broad index, and substantially better than the growth index. Now, this is not linear, and some of this has reversed already, but we do think there are signs of this, and the evidence is there, and we actually think that 2021 provides a significant amount of support for this to continue and accelerate as the year progresses. There is historical precedent when one looks at periods like 1995 to 2000, which were substantially beneficial for growth type investing. The years subsequent to that, which were known as the dot-com bust, value substantially outperformed. And so much so that even when one takes 95 to 2005, which takes the whole cycle, value significantly outperformed. So although we're still at the beginning stage of value performing, we think at the end of the cycle, it can be quite a substantial rotation. And that effectively means a substantial amount of money will be made by people in the right sectors, and a substantial amount will be lost in the wrong sectors, even though the index itself may potentially not move much. Now, in the current environment, there are a lot of challenges across different asset classes. One, bonds are no longer have the ability to deliver. Such is their yield collapse in the last couple of years and even the last several months. You cannot get any reasonable return from bonds, and their ability to provide capital returns is likewise diminished. Now, that does create a challenge. It does support the argument that one should have an equity investment where you get dividend yields and potential capital growth. However, the challenge is which equities do you buy? Because as we said, some of those equities are themselves the beneficiary of very strong bond markets. So you are buying bonds in a different form in many ways. And the risk you have is if you buy those equities, you will be severely punished when bond prices decline or inflation goes up and yields subsequently go up, or growth even disappoints and valuations come down, as we've touched on. So the question then is, which equities do you buy? We believe the equities you want to own are those more linked to this new economic expansion, the reset we've talked about, that we've entered into a new economic cycle that's being supported by high levels of monetary and fiscal expansion and an improving economy at the same time. And that should lead to significant earnings growth in the year and the following few years, which will provide a strong impetus to certain segments of the market. So let's look a little bit into which sectors and regions may potentially benefit from this new environment. Well, emerging markets have certainly not been a beneficiary of the strong equity market of the last several years, and as you can see on the chart on the left, have significantly underperformed. There are many reasons for this. They have in many cases been more negatively affected by COVID, and also don't really have the growth tech type names that are dominating the indices and the NASDAQ in particular. But they certainly, both from an equity valuation as well as from currency, provide a better opportunity than they have for many years and are far from being expensive on any metric. The chart on the right is looking at the world, more broadly the world, excluding the US. And as you can see, what's quite apparent is everywhere outside of the US has done significantly worse for similar reasons, which are driven by that concentration and returns driven by a very small cohort of equities within the US that are NASDAQ growth related. So we see an environment where those regions can actually do significantly better, and many sectors within those regions are trading at a very attractive valuations. More specifically at the sector level, financials have been significantly impacted over the last several years by a lower interest rate environment, because interest rates are effectively their pricing power. So with lower and weaker economic growth, higher risk of bad debts given the economic environment we've just gone through, as well as low interest rates, it's no surprise they've been a poorly performing sector. But all of the things we've talked about today are actually supportive of them in increasing economic activity, increasing earnings, higher interest rates, higher inflation, and lower valuation. So we see that as a particularly attractive sector to have exposure to. Materials is another example, and those would incorporate more real economy product, and as the economy goes up and improves, those should start increasing as well. And that would be another example where one can look for opportunities. When thinking about the reset, it's important to look at income's contribution to total returns. Now, income as a component of total return has always been important. In fact, if we just look at the ASX, once one takes out dividends and reinvests the dividends, for example, the market actually hasn't gone anywhere for over 20 years. And in fact, in the US, over the last 100 years, around 70% has been dividends and reinvested dividends. So income has always been important. But now more than ever, given the availability of income in so many places has been diminished, given equity valuations are quite significant in most segments of the market, and given the extreme concentration we've talked about, the ability to generate income as a component of return has arguably never been more important. One of the key features of the Telaria process is it generates a significant amount of income, which obviously contributes to total return, but also provides many other benefits as a buffer against loss and a lower volatility of return. That income that we generate is actually beneficial when volatility is elevated, because the process benefits from higher volatility, such that the income we generated in calendar 2020 was at a 10-year high. And we expect with elevated volatility to continue in the foreseeable future, the income generated from the process will remain high, which is a key differentiating feature in this very income-challenged environment. So in summary, we believe now is the time to reset for success. Concentration risks still exist, especially in long-duration growth equities, and these dominate the index, so provide a real source of risk out there. And inflation could potentially make a significant difference to who wins and who loses in the year ahead. And this should support the gradual rotation to value, which we believe is already underway. Equities, as we've talked about, are one of the few asset classes that does have a natural advantage and does have the ability, if you are in the right sectors and the right equities, that can actually benefit and provide the returns that investors expect from asset markets. But very important, income is increasingly crucial to the achievement of these objectives. Thanks for listening. I hope this was useful. For more information about what we've talked about or what we do, please feel free to get in touch with the team at Telaria. Thank you.